Even if Iran complies with President Trump's call to reopen the Strait of Hormuz by 8 p.m. tomorrow, our next guest does not see a quick fix for global oil flows. Let's bring in Rebecca Babin, senior energy trader at CIBC Private Wealth. Rebecca, thank you for joining us.
Thanks for having me.
All right, so there was a report out we're going to talk about from Citrini. They say there's more flowing than we actually think, that you can actually see online or through some of these services. But you're saying it's not a quick fix. Why not? Why aren't just more flows better for the price action?
So I think when we talk about more flows, I think we need to put it in context. 15 ships is more flows than 2, but it's well below the 60 to 70 ship tankers we need to see to have flows meaningfully restored. So, of course, it takes the edge off the top of where crude can go. When you start hearing people talk about 150, 200, seeing ships move maybe tightens that up a little bit, keeps you inside of 150. But if we talk about getting back to meaningful 60 ships moving through, that is a 1 to 3 month process. Why? Those ships have moved to other locations. They are going to Yanbu to take Aramco's barrels up through the Suez or in the Red Sea. So you got to get all the logistical pieces in place to get those barrels going. And that's just not an overnight process because the whole system has been trying to reroute. And secondly, you need seafarers to want to take that trip. And that's not something that's going to be restored overnight easily, regardless of what anybody says. Even if the insurance is there, I think you got to keep that in mind as well. So I think you're talking about 1 to 2 months, even if we end this tomorrow.
You would imagine safety concerns would be top of mind, not only for the crews, but also for the companies that own the ships. They don't want to lose a ship. I do want to ask you one thing. The fact that we are seeing more flows for whatever reason, whether it's transactions allowing those ships to go through, doesn't that give at least some people peace of mind, or shouldn't it give you some peace of mind? This isn't just about ideology, that this is also about commerce, and that they want to get these oil flowing and they want to make some money on it?
So I think when you bring everything back to markets, for sure, it gives you peace of mind that barrels will find a way. And I think that's a theme that we've seen play out through many geopolitical events. If we look back to what happened in Russia, right? You sanctioned, you price capped, you get a bigger dark fleet. It goes to the buyer who's willing to pay for it. I think, again, the market is focused on this barrels find a way. But when we look at the big picture of how big Hormuz is and how much of a lasting impact that can have if we lose freedom of navigation, that structurally changes the idea of the price of the barrel that travels through. We rely on that spare capacity that Saudi Arabia and UAE have. Anytime there's a price shock, we say, guess what? We've got this spare capacity. That's all behind Hormuz now. The value of that spare capacity is now decremented, right? Because we don't know officially if we can get it, which I think, to Karen's point, when you see that pullback in energy equities, maybe you look at that and say, this market may be structurally different moving forward.
And so, Rebecca, first of all, thanks for being here, because it's great listening to an energy trader who also says there's no edge in trading headline risk in energy. And you've been doing this for a long time. So, but adding to that, this sounds like this is an opportunity for investors that haven't been investing in energy. As you see it, there really is a change going on here, or at least a medium-term change that could have energy positioning still be very underweight.
I think if you're speaking to the equities, absolutely. I mean, what are they, 2.6% of the S&P? Yeah. Maybe they ticked up over 3 over this last move. It's underowned, it's underloved, it's underweight. Listen, we got to be careful here. We're not going to chase every rally, and I think that's the point. This is more of a trade after the trade, maybe, where you look for that pocket. But I do think you're right. This is a medium-term potential shift in trend and something to really focus on. And the flows, if they start to come into energy in a real meaningful way, typically what people do is they rent energy. They're renters, not holders,
Dance
not
by
buyers.
The door.
Right, and they're ready to exit. Maybe that changes, and that does bring the sector kind of into a higher weight. Now, I do want to be careful. It's not buy at any valuation, right? These companies are going to release earnings. We want to see continued discipline, balance sheet strength, right? So that's all going to still matter. But I agree, over the medium term, it might have changed the game a little bit.
Rebecca, real quick, explain in terms of the backwardation in crude. I think there's a lot of thought that the market says in 6 months from now will be significantly lower, and that may be true, but it's not necessarily true. Backwardation historically is a very bullish indicator for commodities.
Backwardation is at extreme levels right now. I think TI backwardation's at $11. We're at 110 front. Let's call it 98 in June. That just tells you the demand for the barrel now is extreme. And all those contracts, as that continues, roll up, roll up. They don't roll down, which is what you do when you're in contango. For sure, the curve says 70-ish, 72 by deck. But if they keep rolling up because that demand is there in the spot market, that's a higher market from there. Got to be careful, though. This is headline driven. And as much as we go up, it can come out very quickly on one headline. So I don't recommend taking shots on headlines. You trade options, maybe a call spread, a defined risk reward scenario where you play a range, but you know what you're going to lose if you're wrong.